Beginning the week with Gold Game Film, we have Frank Holmes setting up the week for us. Frank, thanks for joining me today.
Good to be here.
So Frank, what are we going to see this week? Are gold prices going to behave like the Green Bay Packers last night and blow out the Chicago Bears, or are you going to see a primetime beating like the Bears took? What do you think?
Well, Chicago seems to be in a deep freeze, and it'll continue. But I think that gold is clawing for a bottom. So when it's going to happen, I do not know, because this great decline we've experienced is highly correlated to declining global GDP. That's real GDP has been declining since 2011, and the only muscle man out there today is America. And history is replete of showing that anytime we get a strong dollar 6 months out, the U.S. economy starts to slow down, because much of America's growth relies on exporting technology goods. So this idea of competitive currency devaluation is very dominant.
All right, Frank, let's start with your SWAT report this morning. You had an interesting note about Canaccord Genuity's report focusing on some of the major indexes and how they're looking for a bottoming out phase right now, or a correction phase. Now, you see this as a strength for gold prices. What can we glean from the report? What do you make of it?
Well, I think the important point is that this decline is the second longest. The longest was from 1987 to 1991. So you think of the crash of 87, and it wasn't until the S&L crisis had bottomed in 1991 did the junior stock market take off. And a lot of that had to do with the discovery, which sadly enough became a fraud on the BRICS. And but there was also huge gold activity in Latin America, in particular Venezuela, at this point, that ignited economic activity in the capital markets in Canada. So that cycle lasted 45 months. This is 43 months. So between now and Chinese New Year, I think we get some bottom. And
switching it over to our OT segment, we're going to start with opportunities right now, looking at the WGC report that came out last week, focusing on what they expect to see is a 20% jump in 3 years in terms of demand coming out of China. Now, I find this interesting because you have some analysts and some mining industry gold leaders who are saying we're reaching peak supply either this year or in 2015. And coupled with the expectation of India and China's middle class expected to exponentially grow over the next decade, could we be seeing a real, maybe perfect storm for gold prices in the next couple of years?
Yeah, I think that's a very constructive parts, and I love Dr. Mark Bristow chastising all these CEOs, and I know we've articulated ourselves on issuing stock faster than they can find reserves or increase their production, so diluting their overall value. And I think a lot of CEOs from major corporations have lost their job for such poor decisions. And I think that's good to hear Mark Bristow say that. I think the other part is the great Barry Cooper is a retired analyst, did this incredible piece of research on Jerry Maguire, the movie, Show Me the Money. You get all these CEOs running around the world forecasting and making all these pronouncements of increasing production. And guess what? The average data point was we're going to increase it by 12%, and it was -8. So I think you're going to see supply contract, and Mother Nature is getting more and more difficult with deep deposits.
And real quick, sticking with demand, we'll take a quick look at gold and silver bullion demand. We saw the U.S. Mint just run out of coins, silver coins, last week. So, I mean, demand seems to be picking up. Do you think this is a trend that will continue given the prices?
Yes, I think that you're seeing smart investors, and that is buying silver because it's at a big discount, and it's a very constructive, positive way. So often it's negative regarding the retail investor, but I think they can turn around and put a little bit of that money into silver and diversify.
And moving over to threats, lately we've seen banks just cutting their forecasts for gold prices into the end of the year, 2015 onwards. Now, a lot of these forecasts have been cut, or some of these forecasts have been cut to the sub $1,000 level. So, I mean, are you putting in anything into this right now?
Well, they've usually been wrong, in this forecasting methodology that they use. And so if gold goes above its 50-day moving average, then a lot of them will half of them will swing over to doing a positive forecast. And if it goes above its 200-day, then they all become positive. What people don't realize is that gold is where it's trading at today. In 2007, it's still substantially higher. It's magnificently higher. And what's happened is that many of these companies have got their costs out of line for where gold is trading at.
Excellent, Frank. Now it's time for you to drop out of the pocket and throw that deep touchdown pass. What do you have for us this week?
I got my ball back here. I'm ready to throw it. Look for industrial production numbers coming out of China. Industrial production numbers are highly correlated with resources and commodities. And remember that China is the 800-pound gorilla of the commodity world. Wherever they need, get long, and whatever they have extra, get out of the way.
Excellent, Frank. Thanks so much for joining us today. Enjoy the week.
Take care.
And thanks for watching this edition of Gold Game Film. If you have any comments or questions, don't hesitate to send them to newsfeedback@kitco.com. Have a good one.